In the volatile world of finance, hedge funds stand out as a complex investment vehicle largely reserved for the ultra-rich. Billions of dollars poured into these funds resemble high-stakes gains, seemingly without losing propositions. But behind that glamour lies a system riddled with risks and strict rules that not everyone understands. Hedge funds operate with flexible, sometimes risky, investment strategies, exploiting both rising and falling markets to seek profits. Although described as effective money-making tools for the financial elite, they are not a quick path to wealth. This world is closed off, complex, and leaves little room for error, making it difficult for outsiders to access or learn if they don't truly understand the rules of the game. In the 1950s, Alfred Winslow Jones, a sociologist, conceived a completely new investment concept: the hedge fund. Not hailing from Wall Street or being a financial trading expert, Jones approached investing with the mindset of a social researcher. He combined buying stocks of promising companies with short-selling stocks of companies he believed would decline. Jones's method aimed to mitigate risk in all market fluctuations, much like buying insurance when traveling, preparing to cope when something goes wrong. This idea formed the world's first hedge fund. With the goal of flexible and cautious investment, not merely profit-seeking, Jones wanted to protect investors from unforeseen losses. His method was considered a responsible approach in the financial world at that time. However, today, the image of hedge funds has completely changed. They are no longer just tools for balancing risk. Many current funds engage in high-risk investments, operate discreetly, and are only open to a small group of specially qualified individuals. This stark difference raises the question of what pushed hedge funds away from Jones's original direction. To answer this, we need to re-examine how these funds operate and consider a past event that shifted the entire global financial market, leading to many changes in how governments attempt to protect their citizens' assets. The financial market is not just about money. It's about psychology, strategy, and knowledge. Seasoned investors like Warren Buffett and Charlie Munger spend most of their time reading because they understand that good investing starts with knowing exactly what you are doing. To understand why modern hedge funds can operate independently, escaping many general regulations, we need to look back at the context of the 1920s in the U.S., a period considered the golden age of the country's economy. During that time, large companies like Ford transformed manufacturing with assembly lines, creating an industrial revolution. Fast production, reduced costs, and more goods reaching consumers. People's incomes and living standards significantly improved. For the first time, they gained access to products like cars, radios, and refrigerators, symbols of a newly defined modern life. In this context, stock market investment became a widespread phenomenon across the U.S. Like a national sport, the buying and selling of stocks were incredibly vibrant. People flocked to the market with almost absolute faith that stock prices would always rise. Many borrowed money to invest despite the risks. The market was completely devoid of oversight. No one checked the legality of listed companies. There were no regulations on insider trading or market manipulation. People easily poured money into non-existent companies, imaginary mining regions, or airlines without a single plane. The prosperity that occurred too quickly and without control created a gigantic bubble. Blind faith in the allure of profit pushed the market to the brink. By October 1929, the bubble burst and panicked investors engaged in a sell-off. The total market value evaporated by nearly 90% in just a few years. The banking system collapsed as businesses went bankrupt, leaving millions penniless. That was the turning point that initiated the Great Depression, an unprecedented economic crisis in modern times. Facing such severe consequences, the U.S. Congress had to act. The Securities Act of 1933 was enacted, requiring companies to provide truthful financial information when issuing stocks. Subsequently, the Securities Exchange Act of 1934 led to the establishment of the U.S. Securities and Exchange Commission, SEC, a government agency dedicated to overseeing the market, enforcing regulations, and protecting investors. From this point on, When investing in a company, people could access authentic financial data, audited reports, and fair access. Information transparency and a level playing field became the new principles. But it was also from here that the question arose. If everyone followed fair rules, how could one get ahead? It was precisely this desire to transcend common limits that opened a separate path where modern hedge funds found their opportunity. This was unexplored territory not meant for the masses, and it began with the costly lessons of history. After the 1929 stock market crash, the U.S. Congress enacted numerous regulations to protect individual investors, but there remained a way to bypass these rules: not participating in public markets. That's when hedge funds emerge. They are private entities that do not raise capital from the public. To invest here, you must be an accredited investor. Simply put, you must be very wealthy. Specifically, you need a net worth of over $1 million, excluding your primary residence, or an annual income exceeding $200,000. Thanks to this, hedge funds are considered a legal exception, skirting regulations applicable to public markets, arguing that the wealthy are capable enough to determine their own risks and do not need the protection ordinary people do. In practice, a hedge fund doesn't need to be a fund in the traditional sense. It's more like a small group of very wealthy individuals investing discreetly together. Because they don't operate in public markets, they are not bound by transparency or investor protection rules. Operations within a hedge fund are also quite opaque. Wealthy individuals contribute money and entrust it to a manager. This manager then operates behind the scenes for 1 or 2 years. There's no regular information provision, no public reporting, and no specific oversight. It is a discretionary type of investment where investors barely know what is happening. All they do is wait to see the results, whether their invested money will generate a return. This raises a question. If the public market is transparently organized, why would people choose to avoid it? Perhaps the answer lies in the freedom that hedge funds offer. This freedom allows for the experimentation with all sorts of complex strategies, investing in little-known assets, thereby forming a separate financial world where the ultra-rich create their own path to grow their wealth. Contrary to the common perception that investors simply await the success of a new tech product like the iPhone to profit, hedge funds operate entirely differently. They do not stick to simple buy-and-hold methods. Instead, they delve deep in the markets that are almost invisible to the public. Their investments might involve interest rates in Japan, real estate funds on the brink of collapse in China, or volatility between oil and gas prices in Texas. They jointly invest in assets that most individual investors cannot access, from private loans, distressed companies, rare art, to unnoticed real estate deals. For hedge funds, almost anything with value can become a subject for trading. Not only do they access niche markets, but they are also willing to accept high levels of risk that public funds, like mutual funds, are not allowed to. They use high financial leverage, complex derivatives, and even short-sell entire economies. Things that would get a public fund manager fired are just daily operations in the hedge fund world. Imagine investing as a fishing hobby. Those who invest in public markets are like casting a line at a crowded pier, where everyone sees each other's bait. It's transparent, easy to enter and exit, and low risk. However, catching a rare fish here is very difficult. Meanwhile, a hedge fund is like a submarine piloted by a small team of experts fully equipped with sonar, secret maps, and modern tools. They dive deep into the financial ocean floor, where almost no one can reach. There, if there are valuable assets, they discover and seize them before the public on the pier even knows they exist. Unlike public investment funds, hedge funds are not obligated to be transparent about what they hold. They don't need to inform investors what assets they bought, how much, or when they sold. There are 2 main reasons for this. First, they need to keep secrets to avoid being copied by competitors. Each strategy is meticulously built and millions of dollars are invested to develop models and research. If imitated, their efforts almost become meaningless. Second is to avoid market impact. If the public knew a hedge fund was starting to buy a certain stock, the price could rise too quickly, preventing them from buying enough desired volume. A similar situation also occurs when they try to sell, and that information causes a sell-off. The story of liquidity is another difference. Investing in a hedge fund means not being able to withdraw money at any time. Typically, there's a lockup period of 6 months to 1 year, or even more, because the assets they invest in are not easily liquidated. If investors rush to withdraw money, the fund might be forced to sell assets at low prices, affecting everyone else remaining. This lockup period also gives the manager enough time for the strategy to take effect. Some transactions require several months, even years, to mature. If everyone could withdraw early, the entire plan could collapse. The final factor that makes hedge funds special is how they pay their operators. Managers almost always make money regardless of investment results. Unless the fund completely goes bankrupt, they still enjoy huge fees. This is also a point of contention for many, because profits may be uncertain for investors. But the fund operator is almost guaranteed to be handsomely compensated. In the world of finance, hedge funds are submarines probing for profitable opportunities in the most obscure and complex corners. And on that journey, they both conceal their strategies and flexibly control capital, sometimes beyond the standards that the rest of the market can imagine or access. At the heart of many hedge fund operations is a fee mechanism called 2 and 20. This compensation model has propelled many fund managers into the ranks of the wealthiest individuals, regardless of their clients' investment results. In this calculation, the number 2 represents a 2% management fee, a fixed amount that investors must pay annually simply for their money to be managed within the fund. And 20 is the percentage that the manager receives from any profits the fund generates. In theory, this structure seems reasonable, but upon closer inspection, one can easily notice the bias in this model. Even if the fund yields no profit, the 2% fee consistently flows into the manager's pocket. For example, a fund with $1 billion in assets will bring the manager $20 million per year, regardless of profitability. That means the manager still earns a large sum of money without having to prove they actually created value for investors. Furthermore, when the fund generates a profit, the manager receives 20% of that profit. If a fund earns $100 million in profit in a year, $20 million of that will be transferred to the manager's account. When combining both fixed management fees and performance fees, their income becomes almost invariant unless the fund incurs very heavy losses. In any scenario, investors always face greater risks, while the fund operator is almost guaranteed to get paid handsomely each year. Although some measures are applied to make this system less biased, such as the high watermark rule, they cannot change the reality that the 2% fee continues to be collected regardless of investment performance. The high watermark rule only means that after a losing year, the manager cannot charge a performance fee in the following year until all previous losses have been recovered. But even during the loss recovery period, the management side continues to collect regular fees. Some hedge funds even impose higher fees in the standard 2 and 20 structure, creating additional difficulties for investors. Although investors can negotiate fees if they contribute a large sum of money, the nature of the model remains unchanged. The manager always benefits more regardless of the fund's actual performance. This imbalance is one of the reasons why hedge funds are strongly criticized. In recent years, many funds have no longer generated superior returns compared to the market, despite still charging high fees. When compared to simple, low-cost index funds like ETFs, many investors feel there is no reason to continue paying high fees for significant risk. The question then arises, why do so many people still invest in these funds when there are other, more economical and stable options? Part of the answer might lie in the allure of alpha, which is the excess return above the market average. In the past, hedge funds had the ability to consistently generate alpha, but the past decade has shown that this is not always the case. And after deducting fees, many funds have underperformed the broader market. Nevertheless, some wealthy investors still choose to participate. Perhaps for them, profit is not the only factor. There may be other less obvious reasons why this model continues to exist, even if it seems less logical on the surface than before. If offered an investment product with high costs, tight control over cash flow, secrecy about operations, and no certainty of outperforming common investment options like index funds, most people would decline. But why do the ultra-rich, who have access to excellent financial advisors, modern data, and almost every conceivable investment option, pour billions of dollars into hedge funds? The answer lies not only in profit, but also in their specific cultural, psychological, and strategic investment factors. One of the biggest attractions is the opportunity to access financial strategies that ordinary people cannot, from high-frequency trading algorithms, bets on global macroeconomic fluctuations, political events, interest rate changes, or legal frameworks, to the use of complex financial instruments and opportunities in private markets. All of these are beyond the reach of the average investor. These tools do not appear on popular trading platforms, and this exclusivity creates a special appeal. For the ultra-rich, investing is not just about seeking an annual return of 7%, but about seeking access to opportunities that cannot be packaged into mass-market products. Some opportunities in hedge funds offer asymmetric returns, meaning small bets with the potential for large wins. The risk-reward ratio is very different. This type of opportunity barely exists in the public market anymore. On the other hand, time and convenience play a significant role. Wealthy individuals often do not have enough time to manage their portfolios comprehensively themselves. Entrusting hedge funds is how they save mental effort while still accessing unique opportunities. They don't just pay to make money, but also to alleviate the mental burden of making complex financial decisions. A simple comparison: participating in a hedge fund is like hiring a private chef. While one could cook oneself, would the quality surpass that of an experienced chef who has cooked at Michelin-starred restaurants and has access to ingredients that ordinary people cannot buy? Furthermore, participating in hedge funds brings another intangible value: social networking and credibility. Many hedge funds operate like exclusive financial clubs for the elite. By becoming a part of them, investors not only contribute capital, but also expand their connections with influential individuals, strategic partnerships, and valuable inside information. Becoming a limited partner in a top fund means gaining entry into an elite circle where information precedes public knowledge and social status is significantly elevated. This is something no public investment platform or online application can provide. In terms of portfolio structure, hedge funds also play a role in risk diversification. Wealthy investors often have assets widely allocated across real estate, listed stocks, private equity, art, and their own businesses. Investing further in hedge funds, which operate independently of general market fluctuations, serves to counteract the ups and downs of their total assets. Even if a fund's performance is not overly impressive, if it contributes to smoothing overall volatility, for many, it is still worthwhile. The aspect of image and culture is another layer of attraction that cannot be overlooked. Media, films, and popular assumptions have created an image of hedge funds as the secret weapon of brilliant financial minds. Names like Renaissance Technologies or Citadel are not only famous for billions in profits, but also for the mystique behind their money-making formulas. Being listed as an investor in such a fund brings a strong feeling of being in a bigger game where true financial magic happens. And even if only a few hedge funds achieve spectacular success, the hope of being in the right place at the right time is always a powerful catalyst. Furthermore, investment motivation is also linked to inheritance, power, and long-term influence. Some hedge funds offer investors strategic control options, from tax optimization, inheritance planning, to geopolitical bets or targeted philanthropy. By investing there, investors seek not only short-term returns, but also participate in a unique ecosystem where capital flows, power, and assets circulate discreetly, efficiently, and sustainably. Initially, hedge funds were merely a tool to balance risk and reward, a clever idea from a sociologist. But over time, they have become something entirely different. operating in a world less bound by rules, with countless sophisticated tools. Massive rewards come with even greater hidden risks. Spectacular victories or sudden collapses can both occur, yet despite everything, money continues to flow in. For those at the wealthiest level, what they are paying for is not just investment returns, but a ticket into a room where the biggest decisions about money are made, a place the general public will never enter. As for most people, the world of public investing remains safe, transparent, and regulated, and that's not a bad thing. The costly lessons of the past are precisely why it was created that way. And the next time you hear about the boom or bust of a hedge fund, the curtain of mystery behind it will perhaps become a little clearer. Thank you for taking the time to watch this video on Economic Story Channel. If you found the content useful and wish to support the channel, please like and subscribe to the video and watch more videos on Economic Story Channel. See you in the next video.